Hey guys, I hope you all are doing well. So, welcome to this ACCA Performance Management Revision session. As discussed earlier and as announced earlier, this is going to be a 5-day revision session which is going to be conducted live. And in this 5-day revision session, I would be focusing upon the different syllabus areas. So, for each of the days, like day 1, day 2, day 3, day 4, day 5, we have actually decided the topics that we are going to be covering. And the topic that is going to be covered in today's session is the decision making. The topic that is going to be covered in today's session will be the decision making. So we'll be focusing on the decision making in today's session. Now, um, what is my approach and what is my strategy going to be with respect to conducting these sessions? So I would be conducting these sessions in such a manner that I would be referring to the latest ACCA CBE examinations and the questions that have been examined in those papers. So I would actually be focusing my discussion on those papers and would be covering the topics through them. Just in case, like I would have ideally wanted everyone to attend this session live, but unfortunately, because we are operating in so many different time zones, it is practically impossible to cover every single student's request to alter the timings of the class. So what I had to do was that I had to find a solution for this, which is I need to announce the class, and then whosoever can join is most welcome to join. But whosoever is unable to join, you can get the recordings of the session at a later stage for review. These recordings, we are going to make them available as soon as possible. Hopefully, inshallah, within 1 hour, 1.5 hour of the completion of this class. But we have targeted a 3 hour time that it will be available within 3 hours. So anyways, let's just start off. I'm actually going to start off one of the recent examination questions. So like the December 2023 paper is the recent exam paper that has been published by ACCA on their CB practice platform. What I will do is that I'll be using the December 2023 examination paper, and I would be doing a past examination question on the basis of this. So over here in front of me is the ACCA CB practice platform. And on this ACCA CB practice platform, I've actually assigned myself the different past papers and the exam practice papers for the performance management. What I'll be doing is I will be going through the December 2023 examination, and that's what the starting point is going to be. The topic that I'm going to be covering is decision making, as I said earlier also. So decision making is the topic that we'll be focusing on. So here in this December 2023, we had an examination question, which was question number, which is, like obviously what is available to us is that it is question number 1, 2, and 3 probably, and that is about the Daisy company. What I would do is that I would be discussing about, I repeat, I would be discussing about the different topics, and I would be explaining to you or revising the different topics that are being covered, and then we would be doing the past examination questions through. So like what happens is that this is one of the questions which is about Daisy company. The requirement in this question of Daisy company is that advise Daisy company's production manager on whether either of the joint products should be further processed and calculate the optimal production plan for period 3. So you have to suggest to them whether the joint product should be further processed or it should not be further processed. And plus what you have to do is that you have to actually give them an idea about the optimal production plan that they should think of with respect to this scenario. So that's one thing that you have to do. So that's one specific point. Okay. So that's one of the areas. So that is, you have to actually suggest to them that whether they should go ahead with a further processing decision or not. And plus, what should be the optimal production plan for the period 2? That's what you have to suggest them. Then it says, based on the optimal production plan given for the period 4. So the examiner would have given you an optimal production plan for the period 4. You have to prepare a profit statement showing each product's profit for period 4. So this is what this question looks like. Now let's move a bit forward and let's see that what is there in the next part of the question. So with respect to the next part of the question, there is this some theoretical discussion which is explain why joint processing costs are considered irrelevant when making a further processing decision, but are considered relevant when assessing the profitability of the overall process. So there is a discussion of the relevant costing here. Then we move a bit further. So it talks about the benefits for Daisy company of investing in an ERP system. So what are going to be the benefits of investing in an ERPS? That's what you would have to talk about. So now let's just start off. Let's just start going through each one of these situations. Let's just start going through each one of these areas, that what is this area covering? So what I would want to do is that, what I would suggest you to do is that just read through this question. I'm just gonna make it available so that you could just read it through. I would just try to zoom it out a bit. So maybe that it could just fit onto one single window. Okay, can you just read it through and then we'll just start off together. Can you just read it through, please? Okay. Um, I'm gonna zoom in again the screen so that it is visible to all of you again. Okay, see what does it says. It says that Daisy company is a large chemical company. One of its chemical processes produces two joint products, Nettle and Monkey. So it's a large company, and the chemical, the processes, what they do is that they produce two joint products, the Nettle and Monkey. So these are the two products. Each of these joint products can be sold at the end of the joint process, the separation point, or can be further processed into enhanced version of the products called Nettle Plus and Monkey Plus. The budgeted information relating to the joint process and further processing for period 3 is as under. The total output of joint process is this. Joint process cost is this. Variable overhead cost is this. Total cost is this. The joint products Nettle and Monkey, apportion joint cost is this. Output from the joint process is this. Selling price is a split off point. Selling price after further processing cost, so and so, so and so, so and so. Note 1, it says joint costs are apportioned on the basis of output. Number 2, normal losses occur at the end of further processing. So once you do further processing, normal losses would occur. Daisy's production manager for this process needs to decide on optimal production plan for period 3. She is unsure if either of the joint products should be further processed after the separation points. They need advice. Now, what I'm going to do is that I'm going to explain to you a quick revision, which may be relevant, may not be relevant for you. But again, uh, because we might actually come across some questions in the future in which this specific situation might be relevant. So if I talk about this, let me just guide you. I hope that you are able to see my screen, huh? Yeah. Okay. So see, when we talk about the joint cost and further processing decisions, so there are things that you should consider with respect to this joint cost and further processing decision. First of all, what happens is that there are usually some manufacturing processes where what happens is that you input something and then certain products are being manufactured, and then after a certain point of time the product gets split into 2 or 3 or 4 or multiple products. So generally when there is a production process, and in that production process, if the products are ultimately split into multiple products, so therefore these products are usually termed as joint products. These products are considered to be joint products. And there is also another type of product that arises from this production process, which is called byproduct. Let's say, for example, if I talk about crude oil refining. So what happens is that the input to the process is the crude oil itself. And once we process the crude oil, process it, there comes a time when it gets converted into the petrol, when it gets converted into the diesel, and depending upon the production facility, you could have multiple type of things. But I would just say that byproduct is, let's say, naphtha. So you have been able to produce what? You have been able to produce you've been able to produce what? Petrol, you have been able to produce the diesel, you have been able to produce naphtha. There are multiple things that you have been able to produce. So generally what happens is that such type of a process, this specific point where the products are split into multiple products, this is called split off point. What is it termed as? It is termed as a split off point. A split off point is the point at which a product is split into multiple categories. That is called a split off point. Now there are multiple scenarios, multiple things that you need to understand. Basically, all the costs that are incurred during this time period, these costs are called the joint costs. And the joint costs have to be apportioned to these multiple products. Now the question mark that arises is that how to apportion joint cost? How to apportion joint cost? So when we talk about it, that how to apportion the joint cost, so there is something that I want to explain to you. That whenever we talk about apportioning the joint cost, so with respect to the apportionment of the joint cost, there are multiple methods. One of the method is you apportion on the basis of output basis. Like for example, you have got joint cost of $200,000. You've been able to produce product A. You've been able to produce product B. So the number of product A that have been produced is 30,000 units. The number of product B that has been produced is 20,000 units. Resultingly, 50,000 products have been produced. So when 50,000 products have been produced, so what is actually going to happen is that the joint costs that are going to be apportioned are going to be like this. For A, it's going to be 200,000 multiplied by 30,000 upon 50,000. For the B, it is going to be 200,000 multiply by 20,000 divided by 50,000. So resultingly it is going to be 200,000 multiplied by 30 divided by 50 gives you 120,000. 200,000 multiplied by 20 divided by 50 is gonna be 80,000, right? So basically the concept of joint cost is that whenever there is a manufacturing product process, and in that manufacturing process, if the costs are to be apportioned, the cost could be apportioned either using the output basis. What we could do is that we could actually apportion using the output basis. Okay, let's move a bit forward. And the next method of apportioning the joint cost is on the basis of the selling prices. Now, how do we split on the basis of selling price? So let's say this, like we had this A, which was 30,000 unit, B, which is 20,000 unit. Let's say the expected selling price is $15. Expected selling price is $20. So this is gonna be 45,000 or 450,000. What is it? So 850,000 is the total of the selling price of both the products. Now what you would do is that to product A and to product B, you would allocate the cost like this. You would say that the cost was 200,000. So hence, resultingly, what's going to happen is that nine four double one eight. What is it? 94118. Right now. So what have we done? We have been able to do this, which is how to apportion the joint cost. So we have understood this, that in order to apportion the joint cost, you need to actually, you can have both of these methods. Now in this scenario, the examiner is not requiring us to apportion the joint cost because he has already apportioned the joint cost, but just because there was this scenario. So that's why I thought that I should explain to you. Maybe it could benefit to you for the subsequent questions. Now, so this is something called joint processing cost. Now there is another concept which is called the concept of byproduct. The byproduct is like when you're producing the two product, when you're manufacturing a product. So as I said that it could lead to multiple products being manufactured. So the concept of byproduct is going to be, it's a low value product. Byproduct is what? It's a low value product. It's a low value product. So usually what happens is that we selling price of byproduct is established and deducted from from joint cost. What happens is that the selling price of the byproduct is established and it is deducted from the joint cost. So let's say, for example, if in the above scenario there was a byproduct that was being manufactured, and what you would do is that you would actually estimated sales value of that byproduct needs to be established. Let's assume the estimated sales value of the byproduct is $12,000. So the joint cost to be apportioned will be what? Will be 200,000 minus $12,000. Like 188,000 would be the joint cost to be apportioned. I paid the joint cost to be apportioned will be what? 188,000. Okay. So whenever we have got the joint cost, joint processing cost, so these are some of the treatments that are there. Now let's move a bit forward and let's discuss further. So at times what happens is that you have got the opportunity of further processing a product. Means you have got a product which is called product A, and you have got an opportunity that either you can sell as it is, or you could like process and convert to A plus or whatsoever. So what would happen is that the examiner could ask this type of a question, which he has already asked in this scenario, which is that if you have got an opportunity to further process a product, will you be manufacturing it or not? So you would simply say what? The incremental revenue from further processing would be established. The incremental cost of further processing would be established. And this is all gonna be compared. This is all gonna be compared. So you'd say that if there are savings or if there are losses. So that's what you're gonna do. If there are savings or if there are losses. So when you talk about the further processing, you would either say that incremental revenues or the incremental cost, and things are going to be like, right? Okay. So let's just start off and let's try to do this scenario where we have got what? We have been given the questions, we have been given the information about the company, the product called Nettle. We have been given the details of the product Monkey. Now there is this total output of joint process, 500,000 liter of output. Joint processing cost is 8.31 million. And this joint processing cost is apportioned like this. And in the note number 1, he says joint costs are apportioned on the basis of output. Okay, so we already know that these joint costs have been apportioned on the basis of output. Output from joint process is this. Selling price at a split off point is this. Selling price after further processing is this. Further processing cost is this. Normal loss in further processing is 0. Normal loss here is 10%. Selling price of normal loss is so and so, so and so. Now we need to establish whether it is to be further processed or it is not to be further processed. So let's just try to understand one of the situations or one of the things that's going to happen over here is There's a product called Nettle Plus and there's a product called Monkey Plus. The two products that are gonna be what is Nettle Plus and the Monkey Plus. So we're being told that it could be Nettle Plus, Monkey Plus. So now how would we do it? We would just try to say that incremental revenue, incremental cost, net incremental revenue. Now, if I talk about existing selling price, revised selling price, what I'm just doing is that I'm copying things from here and I would just connect things there. So okay, the existing selling price is what after further processing is 25 per liter. 20, 25, 18, 29 is this minus this. Is going to be this minus this. Number of units is what? 300,000 and the number of units for the Monkey Plus would be a bit different. Why would the number of units be a bit different? Because there's a 10% normal loss. There's a 10% normal loss. Okay. Extra cost of processing per unit is gonna be what? 8 and 4. Now, what would happen is the incremental revenue is gonna be here. For the Nettle Plus, this multiply by the number of units. For the Monkey Plus, the incremental revenue is gonna be has to be calculated in a different manner. And for this, we would have to do the calculations, which is 29 multiplied by 200,000 units minus 18 multiplied by 200, sorry, 29 multiplied by 180,000 minus this into 200,000. You can't see the screen. Is it with everyone or is it like only with 2 people? Can you see the screen, please? Hello, can you see the screen? I can't hear you. I can't hear you. Maybe you could just stop. I mean, like you could just leave the meeting and you could try to join in again.
see.
You can't see? Others are able to see. Probably some problem at your end for the internet, please. Okay. Now the incremental cost is $8, right? 8 multiplied by is equivalent to 8 multiplied by 300,000. So there is actually going to be this minus this. So there is a loss of 900,000 if we process metal plus further. If you talk about the monkey plus, in fact, I would just add up one more cell here. So you have a normal loss units also available. This plus the normal loss units minus this. Now, if I talk about the monkey plus, how would the incremental cost be calculated or established? How did I get 1,620,000? Okay, let's open it up. The current price, the revised price is gonna be what? 29, but that is only going to be for 180,000 units because the 10% unit would be lost. Whereas the existing price of 18 is for the whole 200,000. So it's the difference between this. Okay. Now the incremental costs are gonna be what? The normal loss arises only at the end of the output. That means every single unit would be subject to incremental cost. So this is what it is going to be. The normal loss units are going to be sold at 1.5, 200,000 into 10% into 1.5. Now, if I try to establish this, it is going to turn out to be 900,000 loss here, 850,000 profit there. What have I done? I would just open it up for that so that you could see this. Yeah, here you go. Now, the question's requirement was that you have to calculate, you have to suggest whether they should be processed and calculate the production plan for period 3. Okay. Metal plus metal should not be processed further as it is incurring a loss when the further processing decision is taken. Monkey should be processed to convert into monkey plus. So monkey should be processed to convert into monkey plus as it is yielding revenues in excess of the cost to be incurred for further processing. So what's gonna happen now? This is what you would actually mention in your answer. Okay. Now, the optimal production plan will be as under. So you would suggest that produce Nettle and produce Monkey Plus. So how would you produce the Nettle? How many units of Nettle? It's 300,000 units. And with respect to Monkey Plus, it's going to be 180,000 units. It's going to be 180,000 units. Right? So we talk about it, and this is how we do calculations. We have the calculations for Nettle Plus. We have the calculations for Monkey Plus. Yeah, is this okay to all of you? Do you have any queries in here? Okay, lovely. Now let's move a bit forward. It says based on the optimal production plan given for period 4, prepare profit statement showing each product's profit for the period. So he has already given to you the production plan for the period 4, and you have to calculate the profit or loss on that basis. You have to calculate the profit or loss on that basis. So let's just start off and let's just start discussing through it. Can you just go through it, please? Can you just quickly go through it? Okay, now let's just see. Basically, it says that in period 4, it has been decided that 280,000 liters of Nettle and 220,000 liters of Monkey Plus will be produced. So what are you going to be producing? Monkey Plus. The portion joint cost for product period 4 are this, and this. Selling prices, further processing costs, and normal losses detail are the same as in period 3. Okay, so this is the relevant information, and what you have to do is that you have to do the calculations on the basis of this relevant information. So let's just try to do this. Requirement A2. Computation of profit for period 4. This is Nettle. This is Monkey Plus. Selling price per unit. Selling price per unit. Further cost. Okay, selling price per unit. Number of units sold. Sales generated. Sales. Further processing cost. Less sale proceeds. Okay. Number of units processed. Normal sales revenue per unit. Normal sales revenue. Normal sales. Sorry. Normal loss. Normal loss units. Normal loss sales. I've just input the selling price of Nettle, the selling price of Nettle, because Nettle is being sold at 20. So we just keep on selling Nettle at 20. The Monkey Plus is being sold at 29. It says that you have to produce 220,000 liters of Monkey Plus. So number of units sold is 280,000, 220,000. The sales are going to be here, which is going to be this into this into this. Right? So there's this Nettle, there's this Monkey Plus. Okay, then we talk about the further processing costs. Okay, because you are not going to be processing Nettle after further processing. Robin, you're not going to be processing further Nettle. You would be selling it as it is. Okay, lovely, you got it. Okay, next we talk about the further processing cost. It's like 0 here. It's gonna be 4 here. The number of units that are gonna be processed is 280,000. And this is gonna be 220,000 divided by 0.9. Now you would say, why am I dividing it by 0.9? Because there is a loss unit of 10%. So the 220,000 units that we are producing, that is after deducting the 10% loss. That is after deducting a 10% loss. So this is the number of units on which the further processing cost would be incurred. Total further processing cost, which is gonna be what? Which is gonna be this multiplied by this. Okay, normal loss sales revenue per unit is what you have to establish. It is nothing in here. It's 1.5. Normal loss units, nothing in here. Here it is basically this into 10%. Normal loss sales is this into this, which is again 0. This is 366667. Okay, so what have we been able to get? We've been able to get what? We've been able to get the sales We've been able to get the total further processing cost. We've been able to get the normal sales, normal loss sales. Then you have got apportion joint cost. We have been given the apportion joint cost here, which is 4.5 million and 3.3 million. Now, the profit slash loss for the period is gonna be this sales plus this normal loss sales minus further processing cost minus apportion joint cost. So what was the requirement? We have to establish the profit or loss for each period, and we have been able to do that. We had to establish the profit or loss, and we have been able to do that for each one of them. Okay, there is one thing. It has been decided 280,000 liters of nettle and 220,000 liters of monkey plus will be produced. Okay, now let me just guide you something. The way examiner has actually solved this question is that the examiner has mentioned as if we are processing 220,000 liters of monkey plus. But you see, if you have to produce 220,000 of monkey plus, you have to produce extra, you have to process extra quantity. So like I've used this 244,000, but examiner has not used this. Examiner has used 220,000. He has ignored the normal loss, which cannot be the case because normal loss exists. Normal loss exists, so you just cannot ignore it. This is one of the answers. Plus this was the answer. Right? Okay. If anyone has got any questions till now, you're most welcome to ask, or else I'll move forward. Any questions to ask, please? Okay, let's move a bit forward and let's discuss further. Now the question mark that is there is that explain why joint processing costs are considered irrelevant when making the further processing decision, but are considered relevant when assessing the profitability of the overall process. Yeah, any inputs from your end, please? Any inputs from your end? What do you think? Why is it the case? Yeah, any inputs from your end, please? Why do you people think that this is the case? Okay, no inputs from your side. Anyways, I'm just gonna continue this. Explain why joint processing costs are considered irrelevant when making a further processing decision. Now, first of all, when we talk about the relevant costs are those costs which arise because of a decision that is being undertaken. Relevant costs do not include past costs or sunk costs. That is the costs which were incurred in the past, or the costs which would have been incurred irrespective of whatever decision taken. In the current circumstances, the joint costs have already been incurred, and these costs the joint costs have already been incurred, and these costs will not change because of the decision to further process or not to process. Therefore, these costs are irrelevant, that is, should not be considered while making a further processing decision. However, the profitability however, the profitability is hence further processing cost will be relevant cost for what? For profitability calculation. Right? So that's what it is going to be. They are going to be relevant costs for the profitability calculations. Okay, so we have done this scenario, and now we are going to move on to the last part of this question, which is about Daisy Company. And the question is, discuss the benefits to the Daisy Company of investing in an ERPS. So can you just go through this area of the syllabus? Can you go through this area of the question, please? Yeah, can you go through this area of the question, and then we could start discussing about the answer? Yeah, can you just go through it? Okay, now let's see. So basically, uh, what does it say? It says that information on cost and selling prices is collected by different departments within the AZ company and is recorded on individual departmental spreadsheet and the systems. So it's recorded on the individual departmental sheets in the systems. This information is often not shared with other departments. So other departments don't know what is going on. So the production manager rarely has access to up-to-date information. She has heard of ERPS and want to do and wonders if one could be of use to Daisy. Now see, always the questions requirement is discuss the benefits for Daisy of investing in an ERPS. Discuss. Discuss means you will identify and you will explain and you would evaluate this, right? So if I could just talk about benefits, my first pointer is going to be that just write down the things. Basically, it's an integrated system. All departments can access information. Information updated by one department will be updated on a real-time basis for access by all departments. Decision making will be more informed and timely. Decision making will become effective. Any problems could be fixed on a spot. So like you see, what would happen is that the ERPS, how does this ERP operates? Um, just to give you a bit of an idea that how do the ERP operates. So ERP would operate like this. ERP doesn't operate the way that these spreadsheets are being operating in this scenario. The ERP operates in a different manner. Now, what is the overall thing is that like ERPS, the enterprise resource planning system. This is production department. This is stores department. This is finance department. This is procurement. This is sales. This is X department. This is Y department, etc., etc. There's this one system. The production department would update this. Stores department would update this. The finance department would update this. Procurement department would update this. Sales department would update this. All departments would update this specific system. So automatically, whatever the input that a stores department does, this input will be shown here, will be shown to this, will be shown to this, will be shown to this, will be shown to this. Now the second input is done by, let's say, production department. This input is going to be shown to the stores, to the finance, to the procurement, to the sales, to X, to Y. Like basically what happens with ERPS is that there is a centralized system, and in that centralized system, what happens is that everyone within the organization is able to access the real-time information. It's like one point of entry. You don't have to enter the information on multiple pointers. So let me just write down single point of entry into the system rather than multiple departments single point of entry into the system rather than multiple departments processing the information rather than multiple departments processing the information, right? So this is what it is going to be. It's going to be single point of entry into the system rather than multiple departments processing the information. So basically you just need to elaborate these pointers, and this is how you would be able to do the question. So do let me know if everyone is okay with it. And in case if you have got any questions, any queries on these questions, please let me know if everyone is okay now. Okay, lovely. Good to see this. So we have done one of the past examination questions, and that was about the Daisy company. And in this Daisy company question, what have we been able to do? We've been able to do the scenario of further processing decisions, that whether we should be further processing a product or not, or whether we should be leaving it as it is, as the way it is. Okay. Now we move a bit forward, and the next basically question that I'm going to start off is, wait a bit. Okay, it is going to be from the December 2022. It is going to be from December 2022. PM. Where did it go? PM. Okay. December 2022. Okay. Here we go. Not this question. This is about this is about another topic, which is the performance measurement area. No, we're not talking about this. Let me just go to question number 3. Okay, yes. So we have got another question, and that is basically going to be a question again on the decision making. This is one of those questions that's going to cover up the concept of the payoff table and the payoff metrics, and then the perfect information. So let's just talk about this question and see how things go about in this. It says Ketone Company is a recently established business specializing in the manufacture of a range of products for fitness and health food market. It has recently developed a new product called Protein Power, which it almost ready to launch. Ketone estimates that demand will be between 3,000 4,000 units per month, but Protein Power can only be manufactured in the batches of 500 units. Okay. Therefore, Ketone must decide whether to manufacture 3,000, 3,500 or 4,000 units. So what happens is that they are manufacturing a product, and that product could actually be manufactured either in the batches of this 500. So they are deciding whether they should manufacture 300, 3,000, 3,500, or basically 4,000 units. Given the short life of Protein Power, any units remaining unsold at the end of each month must be thrown away and will have no scrap value. Okay. So thrown away, no scrap value. The variable production cost of making 1 unit of Protein Power is as follows. So there's this direct material cost, there's this labor cost, there's this variable overhead cost. Okay. The Protein Power will be processed on machine X every time the machine is set up for the new batch of 500 units. It must be cleaned and inspected at a total cost of 240. In addition to the above production cost, Ketone incurs selling and distribution cost of 0.9 for every unit sold. Ketone Company has only launched one other similar product, and based on the information from that launch, has estimated that the probabilities associated with each demand level for Protein Power are as follows. So 3,000, 3,500, 4,000. However, while Ketone believes that it could achieve a selling price of 35 protein power for to sell up to 3,500 units, it would need to charge a lower selling price of 33 per unit for all units sold to achieve a sales volume above this. So any volume above 3,500 units will have to be sold at 33, and that would be applicable on all units sold. Managing director is very risk averse and is concerned that probabilities noted above may not be accurate. She has been in discussion with a local market research company who was offered to provide a fee for 100% accurate information about the actual demand level for protein power. Requirement is it's a 13 plus 3. Construct a payoff table. Payoff actually means profit or loss, to show the possible profit outcomes and recommend the level of production ketone should choose based on expected value. So they want you to suggest on the basis of expected value that what should be the what should actually be done. Now, calculate maximum fee. So this part we're gonna come back again, but right now let's talk about it. So basically, if I could just make it a bit bold, okay. Now see what happens is that A1, which is payoff matrix. When I talk about the payoff matrix, try to understand something. So the payoff matrix is produced like this. There is something which is under your control, and this is something which is not under your control. So the demand is not under your control. It could be of 3,000 units, could be of 3,500 units, could be of 4,000 units. The demand could be of different type of units. That's what the demand could be. Okay, so there is this demand, and then there is this supply. There's this supply also. So I would say that there's going to be a supply which I would draw onto this axis. So again, we would decide that whether we are going to be producing on the basis of 3,000, 3,500 or 4,000 units. 3,000, 3,500 or 4,000 units. Let me just move here a bit. Okay, there is the probability, which is gonna be what? Which is gonna be 20%, 30%, 50%. There's a probability which is 20%, 30%, and 50%. Now what we have to do is that we have to actually do the calculations for this, that what is gonna be the payoff, means what is gonna be the profit or loss at different outcomes. So first of all, let me just create some of the important information to be compiled. Then we could just create a sample model on the basis of which we could just do all the calculations. Let me just try to do something. Okay. Just a second. Okay, there is this number of units produced, number of batches, is gonna be this divided by 500. is gonna be this divided by 500. So the unsold units have no scrap value. That's important. Okay. The variable production cost, variable production cost is how much? Is like 6.2. Material, labor, variable, overhead. 6.2, 2.7, 1.35. Makes it how much? Makes it like 10.25. Each batch cost is 240. Each batch cost is 240. In addition to the above, production costs, ketone incurs selling and distribution costs of 0.9 per unit sold. Selling and distribution cost is $0.9 per unit sold. Ketone launched only other similar products, so and so now. Selling price, expected selling price is 35 up to 3500 units. The expected selling price will be 33 if more than 3500 units. Now, okay. So let's try to do different calculation. Let's say supply, demand. Case number 1. Supply is 3000, 3000, 3000. Demand is 3000, 3500, 4000. Sales is gonna be the supply units multiplied by the selling price. What I would do is that I would log this cell. I would log this cell by putting in a dollar sign here. By putting in a dollar sign here. This would actually mean that when I would just copy in here, it would remain the same, because you see here, just see what's happening. It's this multiplied by this. Here, it's this multiplied by this. Then what actually happens is that production cost, sorry, variable production cost is gonna be this multiplied by is gonna be this multiplied by this. I'll just again put a dollar sign in here. Then what do we have? The variable production cost is done. Batch production cost is gonna be 240 multiplied by number of batches. So in this scenario, the number of batches is gonna be 6. It's gonna be the same. Selling and distribution cost will be $0.9. I'll just put it like 0.9. I would not say dollars. Remove the symbol. How do you do it? So how do you do it? It's like gonna be 0.9. Okay, so now what happens is that we have been able to establish this profit. And this profit is to be shown in here. Like if the supply is 3,000, so you know the profit is gonna be here, the same 7110. It's gonna be here, the same 7110. It's gonna be here, the same 7110. So been able to get this done. Now this was basically one calculation. This was one calculation. Now what I'll do is that I'll just go on to another calculation. I'll just go on to do another calculation, which is gonna be this. Look, see, this is copy again, paste again. Now this time around, I'm talking about a supply of 3,500. 3,500, 3,500, 3,500. So if the supply is of 3,500, the sales is gonna be based on what? The supply, which is the sales units. The sales are gonna be on the demand. They're not gonna be on the basis of supply. So you'll have to change it here. Done? Okay, variable production cost based on the production units. Okay, lovely. Batch production cost is going to change again. The batch production cost in here is gonna be a bit different. It is going to be C13. It is going to be C13. Okay, I'm sorry. I just made an error as to I actually changed what I should not have changed. This is calculation A. This is calculation B. I had to change it in here, which is 3,500, 3,500, 3,500. So how is the sales gonna be? The sales is gonna be, again, you have to make sure that it is like demand unit. Demand unit is gonna be B38 in this scenario. Here it is going to be the supply unit, that's okay. Here again, it's going to be supply unit, that's okay, because the supply is lower. Now, the variable production cost, how do we get this? This is this, multiply by the cost, perfectly fine. Okay, batch production cost. So it is going to be like changed, the formula is going to be changed to C13. Then you have got selling and distribution cost. The selling and distribution cost is going to be paid. The selling and distribution cost is going to be paid on per unit which is sold. So you have this 64, 745, 81795, 81795. So this is what we have got. Now there's this one final calculation which is pending. So we're going to do that one final calculation also. And that is going to be the calculation C, where the supply is of 4,000 unit, 4,000 unit, 4,000 unit. Now, so I think let me just see if I've copied it from here or there. I need to copy from here to here. 4,000 units, 4,000 units, 4,000 units. Okay, how would we know the sales? This is okay for this one. This one, it's gonna change. It's gonna be demand is lower. It's like C49. For this one, it's gonna change again because now the selling price is gonna be different. It's gonna be B24. And then the variable production cost is okay. Variable production cost is okay. Variable production cost is okay. The batch wise production cost, it's like D because that's what it is going to be for batches. The selling and distribution cost is being paid per unit sold. Okay. Is being paid per unit sold. Is being paid on per unit sold. So hence resultingly, this is what the profit is gonna be for all. It is like 59,380, 76,430. It is gonna be 85,480. So what have we got? We've been able to establish a payoff matrix. We have been able to establish a payoff matrix. What have we done? We've been able to establish a payoff matrix in this scenario. Now, if we talk about the computation of expected value of profit. So how would you establish the expected value of profit? Let me just guide you. It is gonna be this multiply by this plus this multiply by this plus this multiply by this. So 7110 is your expected value of profit going to be. Okay. And now what I'm gonna do is that I'm gonna lock the cells in here. I'm gonna lock the cells here. I've locked the cells and I've calculated the expected value of profit for each one of them. Now, what do we need to do? What is the requirement of the question? The requirement of the question was that you were supposed to calculate the payoff table to show all the profit outcomes and recommend the level of production ketone should choose based on expected value. So this is where the maximum profit is being achieved. On the basis of expected value, 78,385 is the highest expected value. So what should happen is that ketone should try to generate this. I mean, like they should produce 3,500 units, and this is what the answer is gonna be. On the basis of the payoff matrix, ketone should opt for the production of 3,500 units, as this will lead to the highest expected value. So this will lead to highest expected value. So this is what they should try to do. This would lead to highest expected value. Do you get it? Yeah, do you understand this? It would lead to highest expected value. Okay, let's start off. So now what is the next requirement of the question? The next requirement of the question is calculate the maximum fee ketone would be prepared to pay the market research company for the information about the actual demand levels. Now see, let me just guide you. What is this happening? Okay, see, there is a concept of perfect information. What do you mean by the concept of perfect information? Let me just guide you through. The concept of perfect information is that, see, here as a company, you are planning to decide whether you should produce 3,000 units or 3,500 units or 4,000 units. And you don't know whether the demand is going to be 3,000 or 3,500 or 4,000. You don't know what the demand is going to be. So you don't know which specific outcome you should try to, because if the demand has to be 3,000, we would produce 3,000. If the demand has to be 3,500, we would produce 3,500. If it has to be 4,000, we would keep on producing 4,000. You get my point? As an organization, our whole objective is to maximize the profit, right? Our whole objective is to maximize the profit. And for us to be able to maximize the profit, we need to know. Because if we know what is going to be the outcome, we would act accordingly. So the concept of perfect information is that if somebody can give you an information and that information is like 100% accurate, that this is something that's going to happen. If let's say I've got a profit of 1,000 here, I've got a profit of 700 here. I've got a profit of 1,000 here again. I've got a profit of 700 here. I've got a profit of 1,100 here. I've got a profit of 900 here, 600 here, 800 here. If somebody tells me that, okay, and again 20%, 30%, and 50%. If somebody tells me it is guaranteed that your demand would be 3,000 units, so I would go for producing 3,000 units. If somebody says guaranteed your demand would be 3,500 units, I would go on to produce 4,000 units. If somebody says your guaranteed demand would be 4,000, I'll go on to produce 3,000 because that's where I'm maximizing my profit. So if somebody gives me perfect information, so on the basis of perfect information, I would say that my maximum profit that I can generate is this: 1,000 into 20% plus 1,100 into 30% plus 900 into 50%. This is what it is going to be. So if somebody tells me guaranteed manner that what is the sales gonna be and etc., what is the demand gonna be, so I know I can generate 980 as the benefit by choosing the right information. Especially I'm incorporating the probability elements also, but I'm just incorporating this. So basically the concept of perfect information is that when you get to know what is the actual outcome is going to be, so you choose a decision where you will maximize the profit out of it. Now here the examiner is saying calculate maximum fee which Keystone would be prepared to pay to the market research company for the information about actual demand levels. Okay, if actual demand levels are known, the amount of average profit that could be earned is as under. Um, 20%, 30%, 50%. Maximum profit, if it is 20%, 7110. If it is 30%, 81,795. If it is 50%, it is gonna be 85,480. Hence, expected profit is gonna be what? It's gonna be this into this. So 81,300 is the maximum that we can earn, the maximum we can generate if we get this. Now, the existing decision based on expected value is what? The existing decision based on expected value is giving us highest expected value of 78,385. So the extra benefit of perfect information will be this minus this, 2915. So if the question says calculate maximum fee that Ketone should be prepared to pay to the market research company for the information about the actual demand levels, is this going to? Ketone can pay $2916 for the as a fee for the actual demand levels if a company could predict. Right? This is what it is going to be. Abid, this is what it is going to be. Right? You get my point? So now we move on to the last part of this question, and the last part of this question is briefly discuss whether it is appropriate for managing director to use expected value as a basis for making the decisions about the production level of protein power, and explain one alternative decision criterion which might be useful, which might be helpful. So what are we gonna do? We need to explain to them that, okay, is it the criteria that is relevant or is it not the criteria? So we need to suggest them something. Now see, first of all, what information do we have about the managing director? It says managing director is risk averse and is concerned that probabilities noted may not be accurate. She has been in decision with a local market research company and so and so so and so. See, what happens is that the expected value technique considers all the potential outcomes and tries to establish an average value on the basis of all the potential returns. This technique is not suited for the risk averse decision maker, but rather more suited to the risk neutral decision makers. Considering managing director to be risk averse, expected value is not the suggested / preferred approach. A more relevant approach will be the one that avoids the risk and significantly eliminates the risk associated with a trade. With a decision. So maximin is an approach which can be used. Under this approach, minimum payoffs for each supply would be established, and then the maximum out of those minimum will be chosen as a decision. Do let me know if you understand this, please. Yeah, please do let me know if you understand this. Lovely. Okay. So we have gone through these two questions and they were about the decision making. So basically my whole objective of conducting the session of today was that I wanted to go about with the decision making questions. And we have now gone through these decision making questions, and I hope that you people would have enjoyed the session and would have now got a proper and a better understanding of how decision making scenarios could be handled. Obviously, I've not covered all the questions, but I've tried to cover some of the recent questions that have been tested about the decision making. So I'll keep it till here for today, and I will continue inshallah tomorrow the same time, and we would start off with again with another area, and we would try to do the maximum practice questions on that.